A proud mother of three amazing children, a 17-year-old daughter, a 12-year-old son, and a 6-year-old daughter. And today we're going to talk to you guys about the $1 Million Baby Plan, right? And this is a very special plan to me because of my children, but also that is when I was introduced to this industry. When I had my son, my family members came to visit and they were ready to talk to me about how to prepare for my son's future. So I started a plan early on for him. Then we started a plan for my daughters as well. So this is something that we believe in, that we are so happy that we learned about, and we are so excited to share with you, right? So as you see here, we do refer to this plan as, I am not sharing my screen, am I? So sorry, guys. We do refer to this plan as the $1 Million Baby Plan. There we go. Um, but we also refer to it as the $1 Million Legacy Plan, right? Because it's actually not only for babies and children, right? We are passionate about sharing this financial tool with parents and grandparents and guardians because we understand the power of time, right? So that is why we focus on the babies and the children, but this is a plan available to all of us. Um, so I'm going to ask, did you guys know that time actually matters more than money? Did you guys know that? Yeah, time matters more than money. And we're going to show you throughout this presentation, right? So today we are going to share with you a concept. Like you see here, it is nicknamed the $1 Million Baby Plan, but it's really just a simple idea of starting early and using the right financial tools, right? So again, I'm excited for tonight's call. I hope you guys are too. If you're able to turn on your cameras, we would love to see your beautiful faces and virtually interact with you throughout the next 30 to 40 minutes. Um, and then next, if you don't already have a pen and paper, I would like for you to take the next few seconds to go grab that pen and paper so you can take notes. And also, as you're listening to the information that we share tonight, if somebody pops into your head that you believe can benefit from this information, then jot their name down as well and let us know so we can help them and share this information with them as well. Right? So, again, I am Marlena Smith. I will come back on a little bit later, but I would love to introduce you guys to one of my favorite business partners. And she is also a mother, very passionate about this call and helping not just the children, but the mothers, the single mothers specifically. It's an honor to do this business by her side. So I hope you guys are, like I said, ready with that pen and paper because we are going to have Miss Princess Map start the call off for us. So Miss Princess Map, the Zoom floor is yours.
Thank you, Marlena, my other favorite business partner. It's such an honor to be here tonight. I am a mom and a grandmom, a mom of four and a grandma of three. And I never knew about this concept. And just since I've been here at OIC, besides all the other great things, this is probably one of my favorite because I've always thought I had to work hard, with all the sweat and all the great ideas to, really set my kids up straight. But learning this concept, I was like, oh, wait a minute. This is the Rockefeller secret or something. So thank you. Honored to be here. And yeah, let's get this show started. Here at OIC, our mission is to empower people through financial education and entrepreneurial mentorship. So before we dive into the $1 Million Baby Plan, we're going to highlight some statistics of our current financial reality. So tonight, we're going to focus on giving our children a financial head start, and we're going to discuss how to guide them into the adulthood with the right habits and strategies for a strong financial future. So let's look at this chart, right? What is the current financial reality? And I even think the numbers have gone up since we started this presentation. 60 to 70% of Americans live paycheck to paycheck. 47% cannot afford $1,000 emergency without borrowing. The average American household has a debt of over $140,000. The average college graduate owes more than $37,000 in federal student loans. Now, I don't know if you have any young adults, but I know there are a lot of young adults now thinking twice about going into debt. I have two, and they're like, well, I don't want a loan. People are getting rich, mom, overnight, being a content creator and things like that. I've heard this through their friends, and it's true. The average monthly Social Security benefit as of 2025 is $1,975 per month. That's only a little bit over 23,000 a year. And the average 403b, 401k is about 240,000 by the age of 60. And the average person will change careers every 4 years, even less time amongst those ages 35 and younger. And I believe all this is true, and the times are not as they look. They're not really getting better, but that's why we're here to make million-dollar babies. So it's time to change the generational curses and create generational wealth. So what we're going to do is take a look at a 2-minute video. It's going to summarize what this million-dollar baby plan is, and we will take a deeper dive and go over the benefits of how this works and how you can get started with your child, with your million-dollar baby today. Alrighty, so let's play the video.
A pretty money-savvy guy once said, "Someone is sitting in the shade today because someone planted a tree a long time ago." So you're ready to start saving for your kids' future. You already understand the power of compound interest over time, so you know the sooner you start, the better. So where should you be saving that money? Let's talk about perhaps the most powerful and least known savings vehicle for kids on the market, Index Universal Life, or IUL. IUL stands out against all other savings vehicles in one main area of strength: flexibility. Other financial vehicles lock you into what you can use your savings on, but an IUL can be a first car, a college education, a down payment on a house, a wedding. IUL cash value can be used however, whenever, and on whatever you choose. Plus, since it's built on a financial chassis of life insurance, your child is instantly covered with hundreds of thousands of dollars of permanent life insurance with living benefits, simply as a side benefit of utilizing IUL as your choice of savings vehicle. Now don't freak out, the fact that it's life insurance is actually a good thing. Life insurance cash value comes with a ton of unique side benefits, like your cash value being protected from market losses, cash value growing tax deferred and being accessible tax-free, protection from lawsuits, and IUL cash value is not considered in asset calculations when applying for student loans for college. So, what could one of these policies look like for your kiddo? Let's say you had a baby today, and to take maximum advantage of the power of compound interest over time, you immediately start socking away $100 per month into an IUL. Right away, your child is now covered with $371,000 of permanent life insurance coverage with living benefits. That's a pretty nice little side benefit. And that financial foundation you establish for them today will continue to grow with them over the years and be available throughout their lifetime for whatever they need or want to use it for. Plus, if they don't access that money, right around retirement, their IUL is conservatively projected to hit $1 million of cash value. And at age 65, they could turn on a tax-free income stream of $75,000 per year that will last them the rest of their lives, no matter how long they live. The point is, they have options. IUL is the most flexible savings vehicle for children on the market, and the best time to plant that seed is today.
Wow, every time I hear that, watch that video, I'm like, okay, how many kids do I have? I'm trying to count those millions. The million-dollar baby plan uses an Index Universal Life Insurance policy, which is a financial strategy designed to build generational wealth. It involves purchasing an IUL policy for a child at a young age and funding it over time. That's what they have on their side, is time to accumulate the cash value. And the goal is to create some type of a lifelong financial benefit, including tax advantage growth, a death benefit, and the ability to borrow against the policy for major life expenses, as you saw in the video. Now, what are the top 3 benefits of the million-dollar plan? I hope you got your pen and papers out. All righty. Well, the cash value growth. Parents, grandparents, or legal guardians can open an IUL policy for any child, and the premiums are paid into the policy, which grows into that cash value based on an index interest strategy, such as the S&P 500 performance with a cap and a floor. So let's see what that looks like. All right. Here, if you look at the three columns, these are the index type of strategies. Excuse me, these are the what is an index strategy? But we're looking at three type of ways of investing, which is a fixed, where you earn a guaranteed interest rate. The risk level is usually lower. Your money won't go down due to the market's loss. And then you have an upside, steady, predictable growth, right? A little bit safe. The downside, it has limited potential on the return, right? It's usually modest, and you can think of it like a high interest savings account or a CD. Now, if you look at the variable account, that one goes a little bit up and down, right? Your earnings are based on the performance of the actual stock market. The risk level is higher. Your value goes up and down with the market. I'm not a risky person, so I do not prefer that one. Upside is potential for the higher growth in the market performs very well, but the downside is you can lose your money when that market drops. And you think of it kind of like the 401k is actually inside of an insurance policy. All right, so now you look at that index one, and it offers a balance between the growth potential and the protection. On this one, it actually mirrors the stock market. The earnings that you see, the market goes up like S&P 500, but it's not actually in and it's not invested in the market, so it's not taking the same risk. The risk level is moderate. There's a cap and floor, so you get some market upside, but no loss, no downside loss. And what is the cap? The cap limits the amount of the interest that the policy can earn when the index performs exceptionally well. The floor, these accounts include a guaranteed minimum interest rate, often 0%. So zero is your hero. And you want to think of it as a safety net that lets you ride the market waves, but you have a life jacket on. So the other benefit is the tax advantages. The cash value the cash value grows tax deferred, meaning you don't pay taxes on the growth as it occurs, and your child can later access this cash value tax-free through policy loans for education, they want to purchase a home, or even for retirement, which is a huge advantage. I like to think about it if your child was going to college and, they actually wanted to maybe purchase a condo. They have one of the units themselves, but they're renting out the other two or three to their buddies, right? So it's a lot of advantages and a lot of different options when you have this type of a policy. And then next, the third one is the wealth transfer and how you create a legacy, right? And what the Rockefellers have done for a long time. The child can continue funding this policy as an adult, allowing it to grow into a potential $1 million asset. Upon the insured's passing, their beneficiaries will receive a tax-free death benefit. And then you have other options, what you would go into more detail with your agent. But this is where the generational wealth is continues for your name to be by the fireplace when those years come. Mama Princess, or your last name. Think of it like that. The Rockefellers don't have to be the only one that passed the wealth. All right, next I'm going to go ahead and pass this back to my partner, Marlena, so she can give you guys some more value of the IUL, of the $1 million baby policy.
Yes, awesome. Thank you so much, Princess, for that information. We can stop the call here, and uh, I'm sure you guys have already received tons of value, but education is our primary goal here. So we want to make sure that you truly feel educated about this product so you can make the decision for you and your family, right? So what if you already are saving for your child or your grandchild, right? Maybe you want to know, how does this compare, right? So like I told you guys, when I first was introduced to this product, I was a brand new mom and I was looking, do I put money here? How do I save for college? Which one is the right plan, right? And I was looking and looking, but nothing checked off all the boxes. So I was so grateful for my family that came, right? And they do know actually that they actually gave me a gift of peace of mind, right? Because now I know, at least when it came to my child's financial future, I had a solid plan in place, right? All the other things in parenthood, I don't know. But as long as I know financially I had a plan in place. I did have peace of mind for that, right? But again, like many people, before learning about that $1 million baby plan, I looked into CDs, to high yield savings accounts, to 529 plans. Um, but when people are looking for something to save, right? Somewhere to save and invest for the future, these features right here, these 8 features are I think this is 8 or 9. These features on the left are the biggest features that people typically look for when choosing that long-term savings or investment strategy, right? So number one on here is growth potential, the ability for your money to increase over time, right? We are putting away money because we want it to grow, right? So to increase over time, either through interest, through market gains, or through compounding interest. Next is safety and protection, right? Protection from market losses. And Ms. Princess shared with us that the $1 million baby plan does protect against those market crashes. Tax advantages, right? So opportunities for your money to grow either tax deferred or have tax-free access, right? They say you will never be able to accumulate wealth if you do not understand taxes, right? So this is a huge one. Liquidity, which means access to your money. Do you have the ability to access the money when you need it, right? The goal is for long-term savings, but life happens. So what if there is an emergency or an opportunity that comes up or a life event that happens? Do you have access to that money, right? Your hard-earned money that you are saving for your child. Are there guaranteed benefits, right? So some features that provide certainty, such as guaranteed death benefit, guaranteed lifetime income, principal protection. Do you have flexibility on how much you can contribute, when you can access the money, what you can use it for, right? Legacy and wealth transfer. Ms. Princess just talked a little bit about that. Protection against inflation, right? If your money is growing at a lower rate than inflation, then you're losing money, right? So you want to make sure that your money is in an account that is outpacing inflation. And then the last one on here, which they touched on the video, is that it does not affect financial aid, right? So if we look at these options here, a high yield savings account, definitely a better option than just a regular savings account of 0.01 or 0.02%, right? It does give you that growth potential, the safety and protection because it's not tied into the market. You do have liquidity, some access to those funds, and there is flexibility on what you can contribute into there, right? When you can access. Excuse me. 529 plan does check off a few more boxes. It has the growth potential, some safety and protection. There are tax advantages here as well. The 529 plan, though, is specifically for education, right? So liquidity to your funds is not checked off here because it has to be used for higher education. So if your child does not go to college, then those tax advantages are void, right? You are going to have to pay taxes and penalties to access your money unless it is transferred over to another child or to yourself um, for, again, for education. There are no additional guaranteed benefits with it, not much flexibility. Um, the legacy and wealth transfer is checked off on here, but again, specifically for higher education. So if your child does not use it, you can transfer it to the next generation, but it still needs to be used for education. And then it does have protection against inflation because generally the growth in these 529 plans are higher than the current inflation rate, right? When we look at the $1 million baby plan, we get all of those, which Miss Princess just went over with us, right? There's amazing growth potential. You have that safety and protection for your money, so it's not tied into the stock market. There are tax advantages, so you're putting in already taxed dollars. So when you access it later on down the road, you have tax-free access to your money. You have liquidity to your access to your funds, so it doesn't have to specifically be for education or any other specific thing. It doesn't have to be for medical, for education, for housing. It can be used for any of those things, and you do not have to wait until a certain age to access it, like a 401k. There are guaranteed benefits, such as the death benefit that we talked about, also living benefits, which I'll show you in just a moment. Flexibility, right? These plans are very customizable, and we're going to show you a couple of illustrations to show you just how customizable they are, right? So when we sit down with our clients and do that financial needs analysis, we want to make sure it's a plan that aligns with their goals, needs, and objectives, right? So you have the flexibility of how much you contribute, how long you contribute, when you want to access it, if you want to turn on lifetime income. All of that is available to this in this $1 Million Baby Plan. Of course, the legacy and wealth transfer. So if something were to happen later on down the road, and again, these will be more apparent when we show the illustration, but starting this plan early for your child, if something were to happen to them, their money, with first, if nothing happens to them, right, their money has the potential to grow until into a $1 million asset or more. But if God forbid something did happen to them, because of that cash value growth, the death benefit also grows with it. So they could potentially leave millions of dollars to the next generation. And like Princess was saying, if somebody in my family left millions of dollars to us, for sure their pictures would be on the mantle, right? My family is very close, so everybody's picture is on my mantle. But if they left money, they probably would have a bigger picture. And then protection against inflation, right? These $1 Million Baby Plans average between 6 and 15% over the last 20 years. And then it does not affect financial aid. So this is one that sometimes people don't think about when they start a 529 plan, is if your child does go to college, right? They don't choose the influencer route or the entrepreneur route, and they actually go to college and they're able to use this 529 plan towards their education. If you apply for financial aid, this 529 plan is going to show as an asset and could potentially get you denied for that financial aid. Whereas in the $1 Million Baby Plan, the cash value in there is not shown as asset or an income. So it will not affect your approvability, I guess, for financial aid. Okay. So all of that information, if you are like me, after I heard all of that, I said, this sounds amazing. How do I set up a $1 Million Baby Plan for my child, right? So the process is simple. Number one, like anything, we want to make sure that you are with a reputable insurance company. And here with our Infinite Company, we only work with A-rated companies or higher, right? And you also want to make sure that the company has a favorable IUL product for children, right? So not all IULs are created equal. There are some, when I first started a plan for my child, there was IULs for the cash value, but there were no living benefits attached to it, right? Now life insurance has evolved. Living benefits are now available to children. So I now have another plan for my children to make sure that they have those living benefits. And then structuring the plan properly, a parent or a guardian will own the policy. The child will be the insured. And then you choose the coverage and funding strategy that maximizes long-term cash value growth and aligns with your goals. And again, we will help you determine that during your financial needs analysis. Next, we also want to make sure, like we've been saying throughout the call, the financial education is very important. So we want to make sure that you understand the growth and the protection features of the plan. So what are the market index growth potentials? What are the downside protection and the cap and floor strategies, tax advantages and loan options, and then optional riders for future insurability and long-term care, right? So I'll show you those additional benefits that are available at no additional cost. And then we will just apply and fund. Once you understand it, you're comfortable, you know this is the right choice for you, we will help you apply for this plan and figure out how to fund it, right? So for children, the reason why this is such an amazing plan for them is because life insurance is still based on age and health. Okay, so for children, they have minimal underwriting. They're young, we know that. And generally, children are pretty healthy, right? They don't have any pre-existing conditions for the most part. So there's minimal underwriting for them. You can begin funding early to maximize that compounding growth. And then policy ownership can transfer to the child in adulthood, right? So it does not happen automatically when they turn 18. You can choose when to transfer that policy to them. Maybe your child is not quite responsible yet at 18, and maybe you want to wait till they're 25 or till until they have finished college and they have a career of their own where they can manage that a monthly contribution, right? But the point is to make sure that we are setting them up not just with this policy, but with the knowledge to carry it on to the next generations, right? So, as the scripture says, train up a child in the way he should go. Even when he is old, he will not depart from it, right? So, we as parents, we are responsible for our children that God has put into our hands and our care. So, we want to make sure that we are guiding them correctly and giving them the tools to be successful in their future. So I'm going to show you guys a few illustrations, right? So you can see how does this really work. So this first illustration here, this is a real illustration of one of our business partners, Mrs. Kimberly Howard. Like I said a few years back, living benefits were not available for children. So once we came to our Infinite Company and we learned of this product that did have living benefits for children, we got more policies for our kids because we wanted to make sure they had those benefits, right? So Miss Kimberly Howard and her husband started this plan for their 9-year-old son at the time, and they decided we're going to put $100 a month, right? $100 a month at, like Kimberly always says, every time I step out the house, I'm spending $100, especially here in California. If you have to fill your tank, easily that $100 is out the window, right? So putting $100 here for your child every month is what they're going to do. If God forbid something happened to him, right? We don't want to think of our children going before us, but unfortunately, things happen in life, and sometimes that does happen, right? So instead of having to do a GoFundMe, if that does happen, you'll have this plan in place to help you with that. So if like it says here, he dies tomorrow, 186,000 would go to the family, right? And in no way are we trying to benefit from the death of our children, but this 186,000 will allow the parents time to grieve and not have to rush back, right? Because they still have to make sure there's food on the table for the rest of their children. Uh, this is the part that we've been talking about, right? That cash value growth. What if he needs cash? So if you take a look here, you'll see exactly why this is called the $1,000,000 baby plan. Because they started with putting $100 a month away for their son, by the time he is 69, his projected cash value would be almost $2 million, right? 1,956,365. By age 74, 2,704,000, right? And if you guys have pen and paper, right, I'm going to ask you to write down this number right here, age 69, right? That 1,956,365, because we are going to compare it to another illustration so you can really see the value of time, okay? But again, if he waits until age 84, right, this is not his only policy. So maybe he won't even need to access this for cash. So if he passes away at age 84, $5 million will go to the next generation tax free, right? That for sure is breaking generational curses and creating generational wealth. So this is why we're so passionate about sharing this $1,000,000 baby plan. And then again, if he were to become ill, these living benefits are also now available to our children, right? So if he has a terminal illness, this is projected at age 65, 1.5 million lump sum would be available for him to use for whatever he wants to use it for, right? My cousin that introduced me to this industry, unfortunately, we lost her to cancer back in 2017. And she had a plan like this, though. She had a plan like this in place, and I got to see firsthand what these living benefits does for a family, right? Her husband, she was diagnosed with a very rare cancer in January of 2017. Doctor gave her 6 months to live. She made it to June 27th, right? But in those 6 months, her husband was able to be by her side 24/7 because they were able to put in a claim on this plan and access her terminal illness benefit, right? So they didn't have to worry about Will I be able to stay in this home? Can I pay mortgage? Do I have to rush back to work while my wife is dying? Right? He was able to be by her side. Her mother was also able to be by her side. She had $1 million, actually 1.5 million as well. And obviously she was not able to spend that money in her 5 months, right? So her wish on her deathbed was to pay it forward and provide education for people in underprivileged areas. So she asked her husband and her mother after she passed to take the rest of her money and start schools in Bali, Indonesia, right? In Bali, Indonesia. And I am very proud to say that right now in Bali, Indonesia, there are 5 schools in honor of my cousin Leonor Calaustro with the Bali Children's Project, educating 300 children, 300 children, provided books for them. They even provided buses because many of them were walking to school, miles and miles to school. Um, so that is what something like this can do, right? You don't even need to have a child, right? We have a business partner that has a plan like this for himself. He doesn't own a home. He doesn't have children. He is not married, but he has these plans in place because of these living benefits, right? Because he says, I know if I get sick, my family is going to do all they can to take care of me, right? So he is not just protecting his assets, but he's also protecting his family's. But let's take a look at this, right? So they are putting $100 a month into this plan for the first 5 years, right? $100 a month, 1,200 a year. After 5 years, they are building their businesses and their careers. They expect to have an increase, so they're going to increase it to $200 a month that they contribute in a year. And then once their son is of age, he is going to match what they are putting. So they're going to continue their 200, and he is also going to be putting 200, which will be 400 a month, 4,800 a year. Okay. And then they're going to stop contributing by age 45. So over the years, over 37 years, they would have contributed 147,600 into this plan. But if we take a look here, this 147,000 at age 45 and this accumulated value has grown to 412,108, right? Pretty good return on investment. Plus, he still has the death benefit of 886,000 if something were to happen to him and he passed away. Plus, he still has those living benefits available to him if something happened but he did not die and he needed to access those living benefits, right? At age 49, his death benefit hits that 1 million, right? Hence the $1 million baby plan. And then if we continue to look here by age 60, right? Usually retirement is around 65. By age 60, his accumulated value has already hit over $1 million because they put 147,600 in the correct vehicle. Again, if we look at these ages, by age 70, if he doesn't touch it, it continues to grow, even though they are no longer contributing because of compounding interest, this cash value continues to grow, right? By age 80, as we saw in the previous one, almost $5 million he would leave to the next generation, right? So very, very powerful plan. But again, you do not have to be a baby, right? So this was one of my clients. He's a young 23-year-old male just starting his career and he wanted to start something. He had a lot of questions for me about Social Security, right? What is the maximum he could get from Social Security? So I did the research and then I came back to him with this illustration, right? So as we saw in the beginning, Social Security, the average that people get is a little under 2,000 a month, right? That's pretty difficult to live on and a, a drastic drop in your lifestyle if you're used to making more before retirement and if Social Security is all you have to live off of, right? But I looked to see what is the maximum benefit that somebody can get. And what I found is that it's 5,108 per month, right? But in order to receive 5,108 per month, number one, you must work for at least 35 years. Number two, you have to earn a maximum taxable wage, which in 2025 last year was $176,100 per year, right? So if we just pause there and think about that, you have to make 176,000 a year just so that Social Security can give you $60,000 a year in retirement. Ouch, right? And then in order to access that, to receive that amount, you have to wait until age 70 to claim your Social Security benefit, right? So you're going to work hard all your life till age 70 and then have 100,000+ reduction in income and huge reduction in lifestyle, right? So I showed him this plan, right? And I used those numbers to kind of do an apples to apples comparison, right? And you'll see here he has all of the same benefits as King David did. If he were to die tomorrow, 167,000 would go to his family. The difference here is if he needs cash, I set up what's called a lifetime income benefit rider. So instead of just letting that cash value accumulate, we're going to turn on a lifetime income benefit rider at age 70, right? And then if he becomes ill, he still has all of those living benefits available to him. But let's look here, right? Because he is a little bit older, he has a little less time than King David, we're going to increase his contributions a little bit faster, right? So he's starting with 150 the first 3 years, 250 from years 4 to 6, 350 per month from year 7 to 9, 450, and then we cap him out at $500 a month because that's about the average that we see people contribute into their retirement accounts, right? So over time, over the 35 years that he's contributed, it's a total of 181,200, right? So just like King David's, we look over here, he has that 181,200 has turned into almost $500,000, right? Pretty good return on investment. And then if he's not going to contribute all of these years until age 70, then at age 70, he's going to say, okay, I'm ready to turn on this income. He will be getting $78,948 per year tax-free for the rest of his life, right? And he doesn't have to make a certain amount of money, and he doesn't have to have a certain amount of income before he can access this, right? As long as he's contributing what he's planned to contribute up until age 57, this is locked in for him, right? Again, these numbers are hypothetical numbers. We cannot predict what will happen in the future as far as how the market will perform, how interest rates will be. But based on this, we are only basing it on 6.45%, where the average over the last 20 years is closer to 14, right? So this is a very conservative number, and he would still be getting 78,948 per year. So if we just look at this right here, right? The first 3 years of receiving that income, he already would have received 236,844 in that guaranteed lifetime income benefit because he put 181,000 into this plan. Again, over $1 million he would have in his death benefit if he were to pass away, and money still in his cash value, right? And these plans are permanent plans, you guys. So if we look here by age 100, he still has the coverage, he's still receiving the benefit. He would have received over $2.5 million in this lifetime income benefit. $2.5 million because he put $181,200 into this plan, right? Instead of putting it under his mattress or in a savings account at the bank, right? And again, it's permanent plan. So if he lives to age 120, which I believe is highly possible for him because the number one stressor for people is finances, and that's not a stress he's going to need to have. So if he lives to age 120, he would have collected over $4 million in that lifetime income benefit, right? Most jobs no longer have pensions because it's too expensive for the companies. So we have to think of ways to create our own pensions, right? And even after collecting $4 million in that benefit, he will still have 88,687 to leave behind for his family so they can take care of his final expenses. And I'm sure if he's getting this type of money throughout his lifetime, his family is getting spoiled throughout that time as well, right? So those are just two examples of how we can customize these plans, how they can work for your children, for your young adults, or even for yourself, right? So I'm going to pass it back to my sister, Miss Princess Map, to close us out. But I really hope you guys gained some valuable information tonight from all that we've shared and from these illustrations.
Thank you, Marlena. Wow, wow, and wow. Let's put some ones in the chat. If you thought that was valuable, that information is definitely life-changing. So let's just summarize. What did we go over? The benefits of a $1 million baby plan with an IUL, right? Who wants one? Raise their hand. Who has a grandbaby or a baby? This is the future, and call me crazy, but I tend to think nowadays with everything that's going on, I'm thinking about my big giant mansion and my land. Why? Because my kids are going to be set up right. They're going to be able to take care of me in a way that I probably couldn't take care of myself. Now, had my mother's mother knew about this, I'd be in a different situation. And I want to just share this little story because actually I was on the other side of what happened with Marlena's cousin. Okay, my mom, when I was 18, unfortunately, right after I graduated from high school, she was hit by a car and we did not have insurance. She didn't die, thank God, but she was in a coma for a few weeks, and for the rest of my adult life, she was in a wheelchair. But had I had those living benefits in place, I would have had the assistance, or had she had it in place, I would have had the assistance I needed to take care of her. So there's a huge difference, you guys. So, yes, tax advantage growth, right? Cash value that grows without immediate taxation. Wow. Market protection gains are capped, but there's a floor to prevent losses. Legacy and death benefit provides financial security for future generations. A flexible access to funds. Loans can be taken tax-free for major life events and expenses. They don't care what your credit looks like. That's a big difference. It's your money. Contributions will come back to you one way or another. Cash value through living benefits or income or the death benefit. So these are all the benefits of having this type of a plan, which is exciting to know. So why would you want to start early? Well, if you start early, it does allow you, as you saw the 9-year-old compared to the 23-year-old, you saw the difference. Time does count. Lower monthly and total contributions, more years for compounding that growth, the greater long-term cash accumulation, a future financial flexibility, and lifelong insurability. So these are the reasons why you want to get your baby started now. It doesn't have to be a baby. It could be a little human, an infant. It could be a young adult. It could be a teenager. But time matters more than money. And that's why it's important to
Actually,
start
Miss
now.
Princess, I'm going to go back really quick in case somebody actually wrote down that number that I asked you to write down from King David when he was 69. I wanted to show you, right? We said time matters more than money. If we look at, their plans looked pretty comparable, right? We put 147 into King David's. He had over 400,000 by that time. Here, 181, he had almost 500,000. But if we look at age 69, right? At age 69, did anybody write that number down? Anybody? Anybody? All right. For the sake of time, I will provide the number. So at age 69, King David would have had 1 million. Not, oh, I don't even have it right here. Ain't that something? Hold on, hold on. I'm gonna go back. 1,956,365, right?
956, 365.
365, right? But if we look at Mr. Start Late here at age 69, what would he have, right? It still looks good. Oh, wait, we're 69, you guys. I'm sorry.
Yeah.
He would have 1,096,507, right? It still looks good, but because he started early, oops, minus 1,096,507. Because King David had more time for his money to compound, that was an $859,000 difference, right? Most people don't even have half of this in their retirement savings from saving for 40 years in their 401k, right? So because they started early with King David, not only did they contribute 30 something thousand less, they also have 859,000 more by the time he hit age 69, right? So that's what we mean when we say time matters more than money. All right.
Yes, it does. So I bet you're asking yourself, how do I get started with this? What's the next steps? Well, what we want you to do is get back with the person that invited you, set up an appointment to structure out your own personalized plan for your children or your grandchildren. And then let us help you create that $1 million baby. Refer any parents or grandparents who you would love to start saving for their children or grandchildren. And yes, join us again. If you don't get started, we're looking for you. Next week, if you have a friend you can send, we'll be here every Wednesday. And we hope you enjoyed it. If this was valuable to you, please put some eights in the chat. And be sure to tell a friend. Get back with the person that invited you. We do this with passion and love. We are parents and grandmas. And I learned over the weekend Gigi's and Tata's. So thank you guys for joining us. And God bless. And we will see you next time.
Awesome. Have a wonderful evening, everyone.
Thank you.